The insurer receives a premium from a policy owner in exchange for insurance protection. The premium is part of the policy owner's consideration or the binding force in the contract, which cements the agreement between the insurer and policyholder. Primary factors in premium calculation. Mortality factor, a measure of the number of deaths in a given population. Mortality is based on a large risk pool of people and time. Insurance companies use mortality tables to help predict the life expectancy and probability of death for a given group. Interest factor. Insurance companies invest the premiums they receive in an effort to earn interest. The rate of earnings on investments is one of the ways an insurance company can reduce premium rates. Expense factor. Insurance companies are just like any other business. They have operating expenses that need to be factored into the premiums. The expense factor is also known as the loading charge. Other factors that impact the premium amount. Age. The older the person, the higher probability of death and disability. Sex or gender. Women tend to live longer than men, so their premiums are usually lower. Poor health increases the probability of death and disability. Occupation. Hazardous job increases the risk of loss. Hobbies. High-risk hobbies also increase the risk of loss. Remember, these are typically only important at the time of application. If you tell them you never went skydiving, and that is true, then 5 years later you go skydiving for the first time and die, they will pay. Habits. Tobacco use presents a higher risk than non-smokers. Benefits, options, and riders. The number and kinds of benefits provided by a policy affect the premium rate. The greater the benefits, the higher the premium. To state it another way, the greater the risk to the company, the higher the premium. Premium mode refers to the premium payment schedule and permits the policy owner to select the timing of premium payments. Options include annual, semi-annual, quarterly, monthly. The more payments you make, the more it is going to cost you overall. Ideally, if you could make one payment in a lump sum to start and pay up the policy, you would save the most amount of money. Also, your cash value would begin accumulating right away. The higher your premium payments are, the quicker you accumulate cash value. The higher the frequency of payments, the higher the total premiums, premium terms, and funding. An insurance company's reserves are money that, together with future premiums, interest, and survivorship benefits, will fulfill an insurance company's obligations to pay future claims. Each state has its own reserve requirements. The earned premiums, the amount of premium an insurer is entitled to for the insurance coverage provided, and unearned premiums, the premium collected from the policyholder for future coverage, make up the insurer's total premium. Cost basis. The premiums paid into the policy minus total dividends received in cash or used to offset premiums. Net premium is a premium that makes provision for mortality, death benefit losses only while being influenced by the interest rate assumed, gender, the benefit to be provided, and the mortality rate. Gross premium is the premium charged by an insurer comprised of or influenced by all factors of mortality, interest, and expenses. It is the actual premium paid by the policy owner for life insurance coverage. Gross premium, net premium, insurer expenses. Single premium funding. The policy owner pays a single premium that provides protection for life as a paid-up policy. Single premium funding provides for the lowest total premium and fastest buildup of cash value. For example, John, a 30-year-old non-smoker, buys a $100,000 whole life policy for one single premium of $70,000. Level fixed premium funding. The policy owner pays more in the early years for protection to help cover the cost in later years, which allows the premiums to remain level throughout the life of the policy. The shorter the premium paying period, the higher the periodic premiums, but the lower the total premium paid and quicker cash value builds. For example, John can buy that same $100,000 whole life policy for 10 annual level premiums of $8,000 each, $80. Zero total premiums, or John can buy that same $100. Zero whole life policy for 840 level premiums, monthly for 70 years, for $105 each, $88,200 total. Modified premium funding is characterized by an initial premium that is lower than it should be during an introductory period of time, normally the first 3 to 5 years. After this time, the premium will increase to an amount greater than what the initial level premium would have been, and then remains level or constant for the life of the policy. For example, John can buy that same $100,000 whole life policy for 36 initial fixed premiums, monthly for 3 years, for $50 each, $1. $800 total introductory, and then an additional $804 fixed premiums, monthly for 67 years, for $110 each, $88,040 total remainder. $1,800 introductory, $88,440 for remainder, $90,000. Graded premium funding is a contract characterized like modified by a lower premium in the early years of the contract. However, premiums increase annually or every year for the initial period. It then jumps to an amount higher than what the initial level premium would have been, and then remains level or constant for the life of the policy. For example, John can buy that same $100,000 whole life policy for monthly payments of $20 each year 1, $40 each year 2, $50 each year 3, $75 each year 4, $2,200 total introductory. Then an additional $792 fixed premiums, monthly for 66 years, for $120 each, $95,040 total remainder. $2,220 introductory, $95,040 for remainder, $97,260 total. Flexible premium funding allows the policy owner to adjust the premiums throughout the life of the contract. Minimum deposit financing allows the policy owner to use policy loans to pay premiums due each year. The policy owner only pays the difference between the premium due and the amount borrowed, plus interest on the policy loan. Depending on the type of policy, a policy owner may be able to use the policy's cash value and dividends to pay the premium. Comparing life insurance policy costs. The cost of life insurance depends largely upon an individual's specific circumstances and requirements. However, cost estimates are useful so that the consumer can consider every factor when making a buying decision. A lower premium does not automatically mean a lower cost policy. To that extent, cost indexes have been developed to help in the process of measuring an insurance policy's actual cost. Surrender Cost Index uses a complicated calculation formula where the net cost is averaged over the number of years. The policy was enforced to arrive at the average cost per thousand for a policy that is surrendered for its cash value at the end of that period. Net Payment Cost Index uses the same formula as the Surrender Cost Index, with the exception that it doesn't assume that the policy will be surrendered at the end of the period. The Net Payment Cost Index is useful if one's primary concern is the amount of death benefits provided in the policy. It helps compare future costs, such as 10s to 20s years, if one will continue to pay premiums and does not take the policy's cash value. The interest-adjusted cost method calculates the cost of life insurance, taking into account the time value of money, that is, the investment return on sums placed in premium dollars had these sums been invested elsewhere. The traditional net cost method adds a policy's premiums and subtracts dividends, if any, and cash value. Policy proceeds, living benefits. A living benefit is the option to use some of the future death benefit proceeds before death. Living benefit options include cash value. The cash, equity, that accumulates may be borrowed against, used as collateral, utilized as supplemental retirement income, or may be withdrawn for emergencies or other situations where cash is needed. Accelerated benefit allows someone that a physician certifies as terminally ill to access the death benefit. To be considered terminally ill, a physician must certify that the person has a condition or illness that will result in death in 2 years. Since your doctor has certified that you will die soon, and the insurance company feels confident you will not stop paying your insurance premiums. Since the insurance company also now knows they will have to pay out the benefits soon, They will give you some of the proceeds now and deduct it from what would go to your beneficiary. Viatical settlement allows someone with a terminal illness to sell their existing life insurance policy to a third party for a percentage of the death benefit. The new owner continues to make the premium payments and will eventually collect the full death benefit. The original policy owner is called the viator, and the new third-party owner is called the viatical, or sometimes referred to as the viatee. Life settlement. A life settlement is the sale of an existing life insurance policy to a third party for more than its cash surrender value, but less than its net death benefit. An insured does not have to have a terminal illness to participate in a life settlement. Policy dividends. Dividends are a refund of part of the premium under a mutual insurer's participating policy. The policy owner may use dividends for cash payments, to pay the insurance premium, to purchase additional paid-up whole life insurance, to purchase one-year term insurance, or as an investment to accumulate interest. While not directly tied to the policy proceeds, dividends are still considered a living benefit. Death benefit settlement options. While customarily selected by the beneficiary, the policy owner may select a settlement option at the time of the application and may change the option at any time during the life of the insured. If selected by the policy owner, the settlement option cannot be changed by the beneficiary. Death benefit settlement options include lump sum. Death benefit is paid in a single payment, minus any outstanding policy loan balances and overdue premiums. The lump sum option is considered the automatic or default option for most life insurance contracts. Interest only. Insurance company holds death benefit for a period of time and pays only the interest earned to beneficiaries. A minimum rate of interest is guaranteed, and the interest must be paid at least annually. Fixed period, period certain. The fixed period option is when the insurer pays proceeds, including interest and principal, in minimum guaranteed dollar payments over a specified number of years. Fixed amount. The fixed amount installment option pays a fixed death benefit in specified installment amounts until the proceeds are exhausted. The larger the installment payment, the shorter the payout period. Life income. The life income option provides the beneficiary with an income that they cannot outlive. Installment payments are guaranteed as long as the recipient lives. The amount of each installment is based on the recipient's life expectancy and the principal benefit. Joint and survivor. Benefits will be paid on a lifelong basis to two or more people. This option may include a period certain, and the amount payable is based on the ages of the beneficiaries. Beneficiaries. There are very few restrictions on who may be named a beneficiary of a life insurance policy. A beneficiary can be either specific, a person identified by name and relationship, or a class designation, a group of individuals such as the children of the insured. If no one is named, or if all beneficiaries die before the insured dies, the death benefit will go to the insured's estate. The policy owner is the ultimate decision maker. However, in the underwriting process, the underwriter may consider the issue of insurable interest. Examples of who can be beneficiaries include individuals, businesses, trust, estates, charities. Minors class, having a group named as the beneficiary instead, such as the children of the insured. By order of succession. First in line to receive death benefit proceeds. Secondary contingent. Second in line to receive death benefit proceeds if the primary beneficiary dies first. Tertiary. Third in line to receive death benefit proceeds. If no one named, the death benefit will go to the insured's estate. Distribution by descent. Per stirps, meaning by the bloodline. In the event that a beneficiary dies before the insured, benefits from that policy will be paid to that beneficiary's heirs. Per capita, meaning by the head. Evenly distribute benefits among all named living beneficiaries. Changing a beneficiary. Revocable beneficiary. The policy owner may change the beneficiary at any time without notifying or getting permission from the beneficiary. Irrevocable beneficiary. An irrevocable designation may not be changed without the written consent of the beneficiary. the irrevocable beneficiary has a vested interest in the policy. Therefore, the policy owner may not exercise certain rights, such as taking out a policy loan, without the consent of the beneficiary. Special situations: simultaneous death. If the insured and the primary beneficiary die at approximately the same time for a common accident with no clear evidence as to who died first, the Uniform Simultaneous Death Act will assume that the primary died first. This allows the death benefit proceeds to be paid to the contingent beneficiaries. Common disaster provision. With a common disaster provision, a policy owner can be sure that if both the insured and the primary beneficiary die within a short period of time, the death benefits will be paid to the contingent beneficiary. Spendthrift clause prevents the deceased's creditors from obtaining the death benefit and prevents a beneficiary from recklessly spending benefits by requiring the benefits to be paid in fixed amounts or installments over a certain period of time. The facility of payment allows the insurance company to pay all or a part of the proceeds to someone not named in the policy that has a valid right. Facility of payment is often done on behalf of a minor or when the named beneficiary is deceased. Life insurance and taxes. Premiums paid on individual life insurance policies and premiums paid for life insurance used for business purposes, the company's benefit, are generally not tax deductible. Exceptions to the rule include: premiums on an insurance policy to benefit a charity are tax deductible. Premiums on an insurance policy to benefit an ex-spouse as court-ordered alimony are tax deductible. Employer-paid premiums used to fund group insurance for the benefit of employees are tax deductible for the employer, and neither tax deductible nor taxable to the employee. Living benefits can have tax implications depending on the situation. For policies that are not surrendered, the cash value grows tax-free. If the policy is surrendered for its cash value, the portion that exceeds the premiums paid is taxable. As long as the cash value stays in the policy, taxes will never be imposed on any portion, not even the amount that exceeds the cost basis. Proceeds from a policy loan do not count as taxable income, according to the IRS. However, if you surrender your policy or if your policy lapses, the IRS is notified of the taxable event and taxes may be required. Accelerated death benefit. When benefits are paid under a life insurance policy to a terminally ill person, the benefits are received tax-free. Dividends are received tax-free. However, if the policy owner chooses to leave the dividends with the insurance company as an investment, any interest accumulated will be subject to ordinary income tax. The transfer for value rule applies when a life insurance policy is sold to another party before the insured's death. For this reason, most states require a viatical settlement company or life settlement company to inform the client that the proceeds could be taxable in certain situations and recommend they consult a tax advisor. 1035 Exchange. When an existing life insurance policy is assigned to another insurer for a new contract, the transaction may be treated for tax purposes as a Section 1035 exchange. Policy exchanges that qualify as a 1035 exchange are not taxable. The economic benefit doctrine requires that any benefit granted to an individual that has an economic or financial value be included as compensation for income tax purposes in the year the benefit is granted. Individual life insurance generally avoids this doctrine since premature death can cause a substantial risk to a surviving family. Life insurance proceeds paid to a beneficiary as a lump sum are generally received tax-free. Additionally, proceeds pass directly to the beneficiary and are not subject to attachment by the insured's creditors. If death benefits are paid to a beneficiary in installments, as opposed to a lump sum, the principal is received tax-free, and any interest received is taxable. Another tax cost typically associated with death is the federal estate tax, although most relatively simple estates do not require the filing of an estate tax return.